I honestly don't know. On a risk-adjusted basis, I suspect that Agnico is cheaper than most of the juniors. It sells at higher multiples, but their pipeline, which is stout, is financed. So you have no risk there. That doesn't excite the punters who would rather buy bullshit for a 5-to-1 return. But the folks like me who take a sort of a more measured risk to reward point of view are just going to have to wait and see how the market matures. Traditionally, when you have periods of high volatility, it shakes out the tertiary markets, the penny dreadfuls first. And I would suspect that we will, at some point in time in 2026, have just such a period of volatility. You'll remember back sort of 4 weeks ago, 4 to 5 weeks ago, at the beginning of that period of time, the silver price had just gapped up in the month of December. And at $115, where people were lining up to buy silver. When it fell from 115 to 85, people got nervous and started selling. In other words, nothing had changed with regards to silver, but people's perceptions found it more attractive at 115 to 85. That's indicative of the way spec markets work. And I would hope, frankly, because I have capital to allocate, that we have a lot more turbulence in spec markets and spec markets become affordable again. No, I'm not really a narrative investor. I'm more of a arithmetic investor. My first rationale was that when silver was hated, it was underpriced. When silver was selling for $20 an ounce, you couldn't give it away. And I figured if the hate subsided, that the silver price would rebound. I also knew from prior bull markets that when the precious metals narrative was established by gold and the generalist investors began to tiptoe into the space, that price leadership changed from gold to silver, and that happened. When silver became no longer hated, its view in my speculative portfolio came into question. That's why I bought it. I bought it because it was hated. When it was no longer hated, I had to examine whether or not it was still appropriate in my speculative portfolio. And here's what I discovered in about 8 hours of study. If the silver price went sideways for a year from 75 US dollars, say, by definition, I'd make no money on my silver because it traded sideways. If silver went up, I expected the silver stocks to go up too, perhaps in a greater ratio. But if the silver price held steady, the silver producers were being valued by Bay Street and Wall Street at about $45 an ounce of silver. So the silver producers could conceivably add 50% in value without a move in the silver price. And paradoxically, because their valuations were predicated on $45 silver, if the silver price were to decline, it's likely that there was more valuation room to absorb in the equities than there was in the silver. Given that equation, I decided it was more appropriate for me to store some of my speculative capital in the silver stocks than in physical silver, which is precisely what I did. Now, I'm not suggesting that the market prices will follow the valuations. I'm not suggesting that's going to occur or that it won't occur. But I've learned over 45 years that investing and speculating based on arithmetic rather than momentum or narrative is the key to my making money when other folks don't. In my experience, geopolitics moves gold for the very near term. People use geopolitics to cause themselves to act in a way that they already wanted to act. What causes gold bull markets is a lack of faith in the maintenance of purchasing power in fiat-denominated savings instruments, which is to say it's fear of the US dollar and US bonds. It's fear of the Canadian dollar and Canadian bonds. It's fear of the euro and euro bonds that moves gold, not an adventure in Iran. I think that the momentum that gold had established caused a lot of people to look at gold, wanting to move, and afraid that they had missed the move. The war in Iran allowed them to express a preference that they already had. But it wasn't the sort of preference that over the years has led to systemic gold bull markets. What has led to systemic gold bull markets is the often rational concern by savers that the deterioration of their fiat currency will occur at a faster rate than the yield that they get on their savings. By the way, I think that fear is guaranteed for the next 10 years.
My immediate response is once I see panic enter the system, and that could be a massive collapse a la COVID or the tariff sell-off that we saw in April of 2025 versus what we're seeing here in gold. We saw gold, silver, and here oil, what it's telling me is investors are getting kind of, they're letting their imaginations get the best of them. They're jumping to the worst case scenario in terms of oil going up, and in the case of gold and silver, the best case scenario. Like we're hearing about how there's too much paper but not enough physical. There's all of these things are narratives, and whether or not they're true, it doesn't matter. It creates the FOMO effect. And so ultimately, when you get these, I usually counter trade them when you get these explosive moves. And I absolutely was short oil a little early. I got in around $100 in dollar cost average. When we did pull back to the 75 to 80 level, I did exit that position. But again, the point is that a good technician stays very logical and based, and ultimately uses and watches others' emotion to trigger the inverse move. So any asset has the potential to be a safe haven asset, and any asset that's a safe haven asset can come out of being a safe haven asset. And what I mean by that is that when no one wanted to be in gold and it was boring gold and all these type of things, and same thing goes for silver, well, it was a safe haven asset. You'd go there when things got scary. You knew that gold would be gold and it would kind of generally hold its value. Problem is, it got emotionally attached. All of the retail crowd started to pile in. In fact, it's probably one of the most emotional trades right now based on comments on YouTube and other social media outlets. And that to me tells me that it now has become a run to, I think I'm going to get rich quick type asset, which is not a risk off asset, meaning a safe haven asset. And that's really what we're seeing here is we're seeing that as people get scared, there are people that are in gold that didn't buy it for a safe haven purpose, and therefore they are selling it now. And again, I mean, this was, by the way, this is a classic bearish pattern on the charts, right? We have this down move, inside bar. I remember talking about this level here, and people were so angry at me when I said it was bearish. And then it comes down, makes another bearish pattern, and it's breaking down. And I will go on record saying, we can check in at the end of the year, I think gold by the end of this year is back to $3,500 per ounce. And I think silver is going to be back to about $50 to $54 per ounce by year end. Just based on its lack of volatility, I'll take gold. So gold again would be the one where if it pulls back to 3,500, I'll put more money in on the long side. I'm a buyer long term on both of these assets because again, fiat currencies, the government printing presses, all of this nonsense that we continue to go through, you have to take that into account. But it doesn't mean that in the near term, in the next few months or the next 6 months, it's not going to go lower. And the charts are absolutely telling me this. I mean, look at the bear flag for formation on silver here. Look at the drop. This is an inside bar bearish flag pattern. It generally will break down more often than not based on probabilities. And that 50 to 54 level is likely in the cards for later this year. So again, gold is generally the one that I would always go to if I just want to be as safe as possible. But I will be buyers of both at those target prices. And so, again, I think what people have to understand is you got to wipe out the weak hands. You got to get it back to flush out to be where people start to say, oh, I don't want to be in gold anymore. It's boring. It just goes down. And then it will start behaving like that safe haven asset once again. But you have a scenario here where there are just way too many weak, what we call in the industry, weak hands, which are people that bought it to get rich quick. And so what ends up happening is when they get scared, so these people, let's say you own like, let's say 500,000 people own 5,000 in gold, nothing crazy, just an ounce or so of gold. When Iran gets invaded, or not invaded, but bombed, they start to get fearful and they will sell anyway. So you have a certain amount of investors that did not buy this as a safe haven asset in the last, let's say, 6 months. And therefore, they will get scared and exit the trade, driving it back down. Then you have central banks that will come in, and they still are, and they will buy, and it will start to become that safe haven again. But we want to look into all these different things. Like, wait, is gold all of a sudden not a safe haven? It's more that psychology has changed here in the near term. I still think it will go back to being a safe haven. It just has to wash out.